All right, welcome back to Iron Financial. We're the channel that forges stronger portfolios by putting companies under the microscope and stress testing their financials. Today, Uranium Energy Corp, that's ticker UEC, is on the anvil. Their latest quarterly report just dropped, and it raises a huge question, a question of structural integrity. They are out there telling the market they're building an American energy fortress, a bastion of nuclear fuel independence. Our job today is to run the diagnostics, to check for any and all stress fractures, and to figure out, once and for all, if this company is built of solid steel or if it's just a polished facade. Let's get to work.
So let's start with the story UEC tells the world. They are not shy about it. They lead with this massive claim. America's largest and fastest growing uranium company. I mean, that's not a mission statement. That's a declaration of dominance. It's designed to grab your attention, to tell you they're not just another player in the space. They want you, the investor, to see them as the future, the absolute cornerstone of America's nuclear energy independence. And you know, in today's world where everyone's worried about where their energy comes from, nervous about relying on Russia or its allies for nuclear fuel, this story, this narrative, it's not just marketing fluff. It's a direct appeal to national security, to patriotism even. It's an incredibly powerful story they're selling.
Whoa, hold on a second. Largest and fastest growing? Those are some heavy-duty words. We see them plastered on investor presentations all the time. But here at Iron Financial, our job is to look past the billboard, to tear down the marketing banners and look at the studs underneath. The real question, the only question that matters, is about the structural integrity of the company itself. Is the foundation poured with solid concrete? Is the financial framework actually engineered to withstand pressure, to last for the long haul? Or is this just a bunch of hype designed to suck in capital? That's what our viewers need to know. Is this a real fortress, or is it a house of cards just waiting for one good gust of wind to blow it all down?
Exactly right. And that's our blueprint for today. We are going to start by examining their uranium fortress thesis. Then we're going to deconstruct the balance sheet, piece by piece. After that, we'll look for any cracks in the foundation, analyze their actual blueprint for growth, and then, at the end, we deliver the final verdict. Let's get into it.
Okay, first up, let's give the bull case its due. You have to understand what UEC is selling. And it's so much more than just pounds of uranium. They're selling a grand vision of American energy security. The pitch is actually pretty simple and compelling. They want to become the industrial champion that controls the entire nuclear fuel cycle, from mine to reactor, and keep it all right here at home.
And this quote from their CEO, Amir Adnani, it's not just a quote, it's the entire mission statement boiled down. I want you to look at those key phrases. Vertically integrated U.S. nuclear fuel supply chain. What does that mean? It means total control. It means from the second that uranium is pulled out of the ground, all the way through processing, refining, and finally to conversion, they want to own every single step. In a geopolitical climate like today's, defined by fragile supply chains and conflict, this narrative of pure American self-sufficiency is unbelievably potent. It's basically a nation-building pitch, and it is the absolute undeniable core of their entire investment thesis.
Okay, let's dive into the guts of this thing, because a grand vision, no matter how compelling, is absolutely worthless without the financial muscle to make it happen. You know, talk is cheap, but balance sheets don't lie. For a business like mining, which just eats capital for breakfast, the balance sheet is everything. It tells you if they have the resources to survive the lean years and the firepower to fund growth in the good ones. This, right here, is the core of their fortress.
And here it is, the first massive, steel-reinforced pillar of that fortress. As of the end of January 2026, UEC is sitting on $818 million in total liquid assets. Now let's be clear what that means. This isn't just cash sitting in a checking account. This number includes cash, yes, but also marketable securities they can sell tomorrow, and maybe most importantly, their physical uranium inventory. And that inventory isn't just a number on a page, it's millions of pounds of actual physical yellowcake they hold in drums. They can sell that into a rising market for a quick profit, or they can hold it as feedstock for their future operations. You have to think of this as a war chest. It gives them the firepower to buy out competitors, to slam the accelerator on project development, and to ride out any market storm from a position of overwhelming strength, not desperation. This number alone puts them in a completely different league than 99% of the other uranium miners out there.
Now for the second pillar, and honestly, this is the one that truly reinforces the entire structure. Zero. Total. Debt. Just let that sink in. In the mining sector, a world that is literally built on leverage, where companies take on absolutely crippling amounts of debt just to fund exploration and build out their mines, UEC has none. They owe nobody anything. This is a position of almost unbelievable financial strength. It means they are completely insulated from interest rate shocks that can crush leveraged companies. It means every single dollar of future profit isn't immediately getting siphoned off to service loans. In a cyclical commodity business like uranium, debt is a boat anchor that will drag you straight to the bottom in a downturn. UEC has cut the line. So, when you combine an $818 million war chest with zero liabilities, well, you have the textbook definition of financial fortitude.
So you put it all together, and the picture they're painting becomes crystal clear. They call it a fortress balance sheet, and frankly, based on these two data points alone, it's pretty hard to argue with them. They have the capital on hand right now to transform that ambitious vertical integration strategy from a nice quote in a press release into physical, concrete reality. This balance sheet is their license to build, their license to acquire, and their license to grow without ever having to ask a banker for permission. It's the foundation of the entire bull case, full stop.
Okay, a fortress balance sheet is great. I get it. It looks fantastic on a slide, and it's an easy story to sell. But a fortress that isn't actually producing anything, or worse, is consistently losing money, well, that's not a fortress. That's just a very, very expensive warehouse. The strength of that balance sheet, let's be honest, was built by issuing mountains of shares, not by running a profitable operation. So, let's put the balance sheet aside for a minute and look at the income statement and the cash flow statement, because that's where we see the day-to-day reality of the business, and that's where I start to see some potentially serious stress fractures.
First things first, that whole fastest growing claim, let's put that to the test. Just look at this. In the same quarter last year, their revenue was nearly $50 million. Pretty good. This quarter, it plummeted to just over $20 million. That's a drop of more than 50% year over year. I mean, that doesn't scream fastest growing. It screams the exact opposite. Any investor just looking at this in isolation would see a company whose sales are not just shrinking, but shrinking at an alarming rate. So right off the bat, we have to ask this simple question. What is going on here?
Now, here is where it gets really, really interesting. Where is that shrinking revenue even coming from? This is not my opinion. This is a direct quote from their official SEC filing. The revenue is from sales of, and I'm quoting here, purchased uranium inventory. Let that sink in for a second. UEC is a self-proclaimed mining company. That's their whole brand. But their revenue, the money they bring in, isn't coming from uranium they've actually mined themselves. It's coming from uranium they bought on the open market, held for a while, and then resold. Based on their actual current revenue stream, they are operating more like a uranium trader or maybe a physical uranium fund, not a producer.
And here's the real kicker. Even with that $20 million in trading revenue, they still couldn't come close to turning a profit. They posted a net loss of almost $14 million for the quarter. And if you zoom out and look at the full 6-month period, that loss climbs to over $24 million. So I have to ask the hard question. How can you possibly call yourself a fortress if your core operations are consistently bleeding cash month after month? At some point, a business has to actually make money from what it does. Right now, this one isn't. Every single day that goes by, the operation itself is chipping away at that big fortress wall.
So this is the crucial point. We have to ask, where is the money coming from to cover these multi-million-dollar losses and to fund all these big, ambitious plans? Well, this simple table from their cash flow statement tells the entire story. Look at that top line. For the first 6 months of their fiscal year, their operations used $72.4 million in cash. That's the burn rate. That's money going out the door. Now look at the middle line. They brought in nearly $446 million from financing activities. And what are financing activities for a company with zero debt? It's one thing, issuing new shares of stock. They are selling pieces of the company to the public to fund the business. So that fortress balance sheet we talked about, it was built with shareholder money. And the ongoing operations? They're being paid for by diluting those very same shareholders. For any retail investor watching this, that means your slice of the pie gets smaller every time they do this, and that is a critical risk.
You're not wrong to point out the cash burn and the source of the capital. Those are just the facts. But you're framing them entirely as a weakness. I see it completely differently. I see it as a necessary, strategic, and frankly, aggressive investment. They went out and raised that capital for a very specific purpose, to execute a massive long-term growth plan. That cash isn't just sitting in a vault collecting dust. It is being actively deployed into the field. They are not just burning cash, they are converting it into hard assets, into steel and concrete, into future production capacity. This isn't a crack in the foundation. This is the cost of building the factory on top of that foundation.
And you can see it with your own eyes right here. This isn't just numbers on a spreadsheet anymore. This is real. This is steel, it's concrete, it's piping.
That negative operating cash flow you're so worried about is funding the construction and the upgrades at their key hub-and-spoke facilities in Wyoming and Texas. These are the central processing plants that will eventually turn their raw uranium into a saleable product. You're looking at tangible, physical progress. The money is being spent to build the very infrastructure that will, in the future, generate revenue from actual mining, not trading. This is the price of progress. It's what building a real producer from the ground up actually looks like.
And this right here, this brilliantly illustrates where that mineral property expenditure line item on the cash flow statement is going. It's going directly into the ground. These are drill rigs, turning an exploration concept into a defined, mineable resource. This picture is from the Ludman project in Wyoming. They are actively out there defining and expanding their resource base, which is the ultimate long-term source of value for any mining company. They're spending the money today to make sure they have uranium to mine for decades to come. This is the heavy lifting of growth. This is what it takes.
Okay, fine, but let's go back to that inventory sale. Even I have to admit their timing on that was incredibly sharp.
It was more than sharp. It was strategic. This is what we call the unhedged advantage. While you call them a trader, their disciplined decision not to hedge, not to lock in prices early, allowed them to sell 200,000 pounds of uranium at a fantastic price of $101 per pound. At the same time, the average market price was barely scraping $81. That's a 25% premium over the market. That is not luck. That is disciplined management maximizing the value of the assets they hold. They didn't panic and lock in lower prices with long-term contracts. They held their inventory like a strong hand in poker and waited for the spot price to run, capturing near-peak value. It shows they know how to play this market and play it well.
And all of this investment, all this spending, is translating into concrete, verifiable milestones. Look at the progress across their key assets. Number 1, Burke Hollow, their brand new in-situ recovery mine in Texas, has its construction finalized. They're literally just waiting on the final regulatory rubber stamp to flip the switch. 2, at Christensen Ranch up in Wyoming, they've already completed 4 new header houses and are in the process of building 3 more as we speak. This is literally how you scale up production capacity in the real world. And 3, the Irigaray Central Processing Plant has been fully refurbished and is now capable of operating 24/7. These aren't vague promises about the future. These are concrete, operational achievements happening right now. They are methodically checking off the boxes on their blueprint for growth.
So that brings us to the final verdict. We've seen the bull case, a financial fortress with a massive war chest, funding a nation-building vision of American energy independence. And we've seen the bear case, a company that is consistently losing money, burning through cash at an alarming rate, and funding it all by diluting its own shareholders. So which is it? Is this an incredible once-in-a-generation opportunity, or is it a high-risk trap?
Okay, let's break it down. The steel column, the pros. It's undeniable. That fortress balance sheet with $818 million in liquid assets and absolutely zero debt is best in class. There's no arguing it. They also have, on paper, the largest U.S. uranium resource base, and they are actively spending the money to build out that vertically integrated supply chain we talked about. And as we just saw, their unhedged sales strategy is proven to be a very savvy and profitable tactic. But the stress fractures, the cons, are just as real and just as important. They are consistently posting net losses quarter after quarter. They are burning through tens of millions of dollars from their operations. That revenue, as we established, comes from trading inventory, not yet from actual mining. And all of this leads to a heavy, and I mean heavy, reliance on shareholder dilution to fund the dream. And let's not forget the elephant in the room. There are massive execution and regulatory hurdles still ahead before this grand vision ever becomes a profitable, cash-flowing reality.
And it's important to see what the rest of the street thinks about this balance. Despite all the risks that you've just outlined, the professional analyst community, the people who do this for a living, are overwhelmingly bullish on this stock. You're looking at 8 buy ratings, 1 lone hold, and 0, not a single one, sells. So what does that tell us? It tells us that, for now, Wall Street is buying into the long-term vision. They see the cash burn not as a fatal flaw, but as a necessary investment, and they seem willing to look past the current losses in anticipation of major future production and cash flow.
Which really leaves us with the ultimate question, the one for you, the investor, to decide. When you look at UEC, do you see a future energy giant strategically using shareholder capital to build an untouchable, vertically integrated American champion? Or do you see a high-risk, highly speculative bet where the immense and ongoing costs of construction, development, and just day-to-day operations could ultimately overwhelm the grand vision before it ever gets a chance to turn a single dollar of profit? The answer to that question is everything, and it will determine whether or not UEC belongs in your portfolio. Thanks for joining us here on Iron Financial. We'll see you next time.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to